Imagine waking up one morning and checking your investment portfolio only to be met with a sea of red. Your hard-earned savings, meticulously invested, have seemingly vanished overnight. Panic sets in as you realize this isn't just a blip, it's a full-fledged market crash. Unfortunately for millions around the globe, this nightmare scenario is a stark reality in 2025. Global share markets are in freefall, sending shockwaves through the global economy. From New York to Tokyo, London to Shanghai, investors are reeling from the sudden and dramatic downturn. But how did we get here? What caused this financial earthquake, and what does it mean for our collective future? The answer, like most things in economics, is complex and multifaceted. It's a potent cocktail of runaway inflation, escalating geopolitical tensions, and the bursting of a long-inflating tech bubble, all amplified by the lingering aftershocks of the COVID-19 pandemic. This isn't just about abstract numbers on a screen, it's about real people's lives. Retirement dreams are being shattered, businesses are struggling to survive, and the specter of economic recession looms large. In this essay, we'll unpack the perfect storm that led to this global market crash, explore its far-reaching consequences, and offer a glimmer of hope and guidance for navigating these turbulent times. Inflation, often described as a rise in prices, is a silent thief, stealthily eroding the value of your savings and investments. Imagine your money as ice cream. Inflation is like the sun, slowly melting your ice cream until there's nothing left. In 2025, inflation is rampant, exceeding the Federal Reserve's 2% target, and reaching a concerning 3% in the US. This might not sound like much, but it's like a slow leak in your tire, seemingly insignificant at first, but capable of causing a major blowout down the road. This surge in inflation is driven by several factors, including supply chain disruptions caused by the ongoing Russia-Ukraine war and increased consumer demand fueled by post-pandemic recovery efforts. As the cost of goods and services rises, so does the cost of doing business, squeezing corporate profits and making it harder for everyday folks to afford basic necessities. Central banks, the guardians of economic stability, have responded to this inflationary pressure by raising interest rates. Think of interest rates as the brakes on the economy. Raising rates makes borrowing more expensive, which can slow down spending and, in theory, cool down inflation. However, this balancing act is a delicate one, as raising rates too quickly can also trigger a recession. Adding fuel to the already raging fire of inflation is the volatile geopolitical landscape. The ongoing conflict between Russia and Ukraine, coupled with simmering trade wars with China and unrest in the Middle East, has created a perfect storm of uncertainty and disruption. These geopolitical tensions have sent shockwaves through global supply chains, already strained by the pandemic. The price of oil, a vital commodity, has skyrocketed, sending ripples through virtually every sector of the global economy. From transportation costs to manufacturing inputs, the ripple effects of these geopolitical events are felt in every corner of the market. The uncertainty generated by these events has also made investors skittish, leading to a flight to safety as they pull their money out of riskier assets like stocks and seek refuge in more stable options like government bonds. This mass exodus from the stock market further exacerbates the downturn, creating a vicious cycle of selling and declining prices. For years, the tech sector has been the darling of the stock market, with companies like Tesla, Apple, and Amazon reaching stratospheric valuations. Investors, fueled by the promise of innovation and disruption, poured money into tech stocks, driving prices to unprecedented heights. However, like Icarus flying too close to the sun, the tech sector's wings have melted, and the long-anticipated correction has arrived. The once soaring valuations of tech companies have come crashing down to earth, with some experiencing losses of 50% or more. This tech wreck is driven by several factors, including overvaluation, slowing growth, and rising interest rates, which make it more expensive for these companies to fund their operations and expansion plans. The bursting of the tech bubble has had a ripple effect throughout the market, dragging down other sectors and fueling a broader sense of panic and uncertainty among investors. Section 5. The COVID hangover seeds of crisis sown. While the immediate health crisis of the COVID-19 pandemic may be behind us, its economic aftershocks continue to reverberate, playing a significant role in the current market turmoil. To combat the economic fallout of the pandemic, governments around the world injected trillions of dollars into their economies through through stimulus packages and quantitative easing programs. While these measures were necessary to prevent a complete economic collapse, they also created an environment of easy money, fueling asset bubbles in everything from stocks to real estate. This artificial boom couldn't last forever, and the chickens have finally come home to roost. As central banks tighten monetary policy and unwind these pandemic-era stimulus measures, the air is being let out of these inflated assets, leading to sharp corrections and market volatility. Section 6. Global Fallout, a World in Turmoil. The impact of this global market crash is far-reaching, affecting not just Wall Street tycoons but everyday people worldwide. Businesses, large and small, are feeling the pinch as consumer spending slows and access to credit tightens. Layoffs are becoming increasingly common, particularly in sectors most sensitive to economic downturns, such as technology, manufacturing, and retail. For individuals and families, the crash has wiped out trillions of dollars in savings and retirement funds, leaving many worried about their financial future. The rising cost of living, driven by inflation, only exacerbates these concerns, making it harder for families to make ends meet and forcing many to dip into their already depleted savings. This economic turmoil also has the potential to spill over into social and political unrest. As unemployment rises and people struggle to afford basic necessities, frustrations can boil over, leading to protests, social unrest, and political instability. History is replete with examples of economic crises leading to political upheaval, and the current situation has all the ingredients for a similar outcome. Section 7. A Glimmer of Hope, Market Bottom and Potential Rebound. While the current market outlook may seem bleak, it's important to remember that markets are cyclical. Just as they go down, they also have a remarkable ability to recover and reach new heights. Analysts predict that the market could bottom out by late 2025, with potential global losses peaking at 40%. The Federal Reserve is expected to cut interest rates by at least 50 basis points in 2025, providing some relief for borrowers and potentially stimulating economic activity. Furthermore, governments worldwide are exploring various policy options to stabilize the markets and promote growth, including infrastructure investments, green energy initiatives, and tax cuts. These measures, while not immediate solutions, offer a glimmer of hope for a future recovery. History teaches us that even in the darkest of economic times, opportunities for growth and innovation emerge. The dot-com bubble of the late 1990s, while devastating in the short term, ultimately paved the way for the rise of the internet giants that dominate the global economy today. Similarly, the 2008 financial crisis, while painful, forced a much-needed reckoning in the financial industry and led to stricter regulations and a greater focus on risk management. Section 8. Navigating the storm strategies for the savvy investor. So, what can ordinary investors do to weather this storm and emerge from the wreckage with their financial well-being intact? First and foremost, don't panic. Knee-jerk reactions, like selling all your investments at the bottom of the market, are rarely a sound strategy. Instead, take a deep breath, reassess your financial goals, and consider the following strategies. Hold cash. Holding a portion of your portfolio in cash provides liquidity and flexibility to capitalize on potential buying opportunities as the market recovers. Focus on stable sectors. Consider shifting some investments to sectors less susceptible to economic downturns, such as healthcare, utilities, and consumer staples. Buy undervalued stocks. Market downturns often present opportunities to purchase high-quality stocks at discounted prices. Consider investing in companies with strong fundamentals and a proven track record of weathering economic storms. Remember, investing is a marathon, not a sprint. By staying calm, making informed decisions, and focusing on the long term, you can navigate these turbulent times and emerge stronger on the other side. Section 9. The Long View. Lessons from History, Opportunities for the Future. The current market crash, while undoubtedly painful, is a stark reminder of the cyclical nature of markets and the importance of sound financial planning. It's a time for reflection, a time to reassess our relationship with money, and a time to learn from the mistakes of the past. As we navigate these uncertain waters, it's important to remember that history is replete with examples of markets recovering from even the most severe downturns. The dot-com bubble, The 2008 financial crisis and even the Great Depression were followed by periods of remarkable growth and prosperity. The key is to avoid panic, make informed decisions, and maintain a long-term perspective. By focusing on sound financial principles, diversifying our investments, and seeking professional guidance when needed, we can weather this storm and emerge stronger and more resilient than ever before.